Hi there, Kundai here. I hope you're well, and in this video, I'm going to share 7 crypto trading newbie mistakes that you should aim to avoid. Here are some of the key mistakes that I made as a new crypto investor and trader. Are you ready? The first mistake I have on my list is buying and hoping. So what do I mean by this? So you may know that the basic idea behind trading or investing is to buy low and sell high. This is true, but there are parameters that have to be in place because a crypto coin can go lower and lower or higher and higher. For example, I remember buying a crypto coin and it went lower than my buying price, and I held onto that coin because I believed it would go back up above the price that I purchased it. But what I did not realize was that a cheap crypto can become even cheaper and cheaper. And after seeing popular influencers talking about dollar cost averaging, which can work when implemented correctly, by the way, all that dollar cost averaging means is that you buy more of a same crypto coin as the price goes down to average your buy-in. But it is dangerous to average down on a crypto that is clearly on a downtrend, because that crypto coin can carry on going down and down in price, and one would be buying as it goes down and pretty much be hoping for the price to recover, which is very dangerous. The way the crypto market works is different to traditional retail industries such as the food industry, machinery, houses, clothes, etc. For example, our brains are conditioned to look for cheap prices and buy where there is a sale. But in crypto markets, cheap prices can become cheaper and cheaper and even more cheaper until the downtrend changes. So instead of buying and hoping, it is important to always have a stop loss set. This can be a mental stop loss or one that is on an actual exchange to automatically trigger. More of this is covered in my cryptocurrency trading course, but the idea here is to protect and preserve your capital so that you may find a better opportunity to grow your hard-earned money. So that's the first mistake on the list to avoid. I made that mistake when I was a new trader and when I was investing, and I learned a very painful lesson. So let's move on to mistake number 2. This is investing or trading blindly. So what do I mean when I say investing or trading blindly? When I started trading some years ago, I read up online and watched YouTube videos and started following other trading or investing gurus. And when they made a trading call on Twitter or YouTube, I would just follow blindly by purchasing the crypto coin that they would have suggested in the hopes to make some profits. But most times I got wrecked, which basically means I lost money doing this. And even though some of the calls made included good crypto projects, the issue here was that I had inadequate crypto trading and investing knowledge. Therefore, the first thing one should do before investing their hard-earned money is to learn how the industries work and equip yourself with the fundamental strategies that are needed to succeed. If I had known to perform technical analysis, fundamental analysis, how to set targets, how to set stop losses, and why the entry point was set at a specific price and when to exit, and then I would have been able to follow the calls made by these trading gurus. But I was investing without knowing what was going on behind the scenes. Therefore, I urge you to take a crypto trading course before you jump into the markets. It doesn't have to be my course. I simply recommend that you take time to gain adequate crypto trading and investing knowledge before you dive into the markets. And real quick, if you're interested in a free crypto trading guide, go to PiggiBacks.com or simply click the link in the description below or in the comment section. Next, we have mistake number 3, which is winning all crypto trades. So what do I mean by this? When trading, the aim is to make profit, but what I did not understand as a new trader was that trading is a marathon. There is no single trader that wins all trades. If they say that they have never lost a trade, then they are most likely lying or they haven't traded that much, The aim here is to be able to take small losses because you will lose. Think of it like this. If you owned a casino, would your casino win all the time? Of course not. But the casino will win most times and take small losses in comparison to the overall success of the business. Ever heard of the saying, the house always wins? That's because in the long run, the odds are always in favor of the casino. So as a trader, we want to trade as if we are a casino, so that we are winning in the long run. So if you're someone who cannot take a few small losses, then trading and investing is probably not for you, as it is inevitable that you will experience a few losses. So let's talk about mistake number 4, which is over trading. So what do I mean by this? As a new trader, I remember trying to chase losses that I made. I would take more trades to try and make my money back, and that did not work out. I also had times where I had winning streaks, where I was winning trade after trade and became overconfident and thought that I was unstoppable, which resulted in me taking more trades. And before I knew it, the gains I had made had been lost. Not to mention, by the end of it, I was actually in a huge loss. So over trading is definitely something that we want to avoid. One should always trade with a clear mind and not think that they own the markets, because the markets can remain irrational more than you can stay solvent. The aim here is to always treat each trade independently, as each trade has nothing to do with the last or the past winning or losing trade. Stick to your system or strategy and try not to let emotions take control of your trading decisions. So for example, we don't want to take more trades just because we won the last few trades. We want to take trades because they fit a specific criteria or trading system. So that brings us to mistake number 5, which is not having a trading system. This basically means that one doesn't have a plan or a trading strategy that they follow when placing a trade. Ever heard of the saying, failing to plan is planning to fail? This also applies to trading. As a newbie, I used to follow other influencers without a trading strategy of my own, and this resulted in heavy losses. I cannot express how important it is to have a strategy or a system that you follow when trading that specifies where to enter and exit a trade. Having a system simplifies things, as one would have a specific criteria to follow as the market moves. Systems will have entry and exit signals that will highlight if the market is bullish or bearish, and when the market prices align with the trading system, that is when it is a good time to either enter or exit a trade. So you can see how trading without having a system or a strategy can be very dangerous, as one would end up not knowing when exactly to get in and out of the market without one, causing a lot of confusion and indecisiveness. Next, we have mistake number 6, which is forcing trades. So what do I mean by this? When I was new to crypto trading, because the market is open for 24 hours a day, 7 days a week, I found myself always wanting to be in a trade, which was very dangerous. I felt the fear of missing out, so I always wanted to be in a trade to make sure that I don't miss out on any gains. What I didn't realize was that I was cheating myself, as I was taking positions that did not have a good risk to reward ratio. The odds on a lot of trades that I was taking were against me, therefore making those trades not worth my time, but I took them in the name of I don't want to miss out on gains, which was very dangerous because the trades I was taking did not fit a certain criteria or a trading system or strategy. I was essentially taking a gamble. The trade setups I was taking were not aligned to a particular strategy or setup, but I would still take the trade in hopes that the prices would go back up. That is gambling. This is something that you want to avoid because it can result in making huge losses, if not losing all your capital. So we don't want to force trades, but instead should be sticking to our trading setups, strategies, and plans to increase the risk to reward ratio in our favor. When taking a trade, if there is nothing in the market that fits your trading criteria, do not take a position and be patient enough to wait for a crypto trading opportunity that fits your system or criteria. Same applies if there is a missed opportunity. If you have missed an opportunity that you could have taken when trading, don't take a trade just because you missed an opportunity. We are spoiled in the crypto space with trading opportunities. One just has to learn to be patient. And this brings us to mistake number 7 and our final mistake, which is not tracking trades. So this one is a big one because if you do not track your performance, you will not be able to improve as a trader or investor. It is important to have a diary or spreadsheet that outlines what you buy, when you buy, entry prices, exit prices, how much you have lost, and the reasons why you entered and got out of a trade or an investment. This will allow you to reflect on past trades and see how well you've been doing, whether you're in profit or are currently making a loss, what trades went well and which ones went badly, and outline areas of improvement so that you can tweak your strategies or systems, and also highlight areas that you're doing well in so that you can also do more of that. If you don't track your trades, you won't be able to know if your trading system is working or failing you. So these are basically the 7 crypto trading mistakes that one who is new at cryptocurrency investing or trading should avoid. I hope that you have gained a lot of value from this video, and I urge you to avoid making these mistakes, as doing so will save you a lot of money and time. Thanks for watching, and bye for now.